Hello and good evening, everyone. I'm DJ Gohain from Textile Excellence Magazine. We have been in collaboration with PwC India discussing with industry leaders and policymakers and how to re-energize the textile and apparel industry in this challenging time. In today's episode, we are going to discuss financing the repair, revival, and growth of the industry as we go forward. So, for the keynote address, may I request Mr. Ajay Sankar, former Secretary of DIPP and Industrial Policy Formation, and for the keynote speech. Before he starts, I just like to give him a brief introduction for our audience. Mr. Shankar holds over 45 years of illustrious experience in public service, primarily in the fields of industry, power sector, and urban development. He retired as a Secretary, Department of Industrial Policy and Promotion in the Government of India. He has many achievements in his illustrious career. Let me pick up only one of from all those achievements, long list. He played a crucial role in putting together the stimulus package at the time of the global economic crisis in 2008, which enabled the Indian economy to recover in a short time and again grow over 8%. Now I request Mr. Sankar to take over. Over to you, sir.
Let me begin by thanking you for giving me the privilege of sharing some thoughts with you. I would be making my remarks in sort of through two perspectives. One is the immediate crisis which is spread across the Indian economy due to COVID, and where the sole objective of all concerned should be to minimize the pain and see how quickly we can recover. And this is more challenging because nobody knows when COVID would end and life would be normal. So it's a completely uncertain world. The second perspective, which I would bring in my remarks, is that supposing we were in March or February and we wanted to be ambitious about the textile sector as a whole, then how would we look at it? What kind of ideas would be worth considering? So if we come to the present crisis induced by COVID, I think there is clarity that all that is feasible should be done to protect existing enterprises and make them survive. So many of the decisions that have followed one after the other have this underlying objective behind them. So if we look at the stimulus package, there is this enormous, I think, 3.5 lakh crore of government guarantee for flow of credit to the MSME sector, and textile is a very major chunk of that MSME sector. And I was very glad to find that credit is flowing. I was cautious initially, thinking that getting all kinds of branch managers to take responsibility and disburse credit may prove to be more challenging, but the numbers that are coming out are quite encouraging. Then on the other side, decisions were taken to put a moratorium on debt repayment, keep the bankruptcy process on hold. And now we have the Kamath Committee report, which has given fairly sensible recommendations on restructuring of debt. But in all this, there is still a need for understanding the gravity of the challenge. Because supposing somebody comes with a proposal for restructuring, it is very difficult for anybody to take a realistic view of how demand will grow and therefore how revenue would come, and therefore what is the normal parameters with which I judge a credit proposal. So we are in really very difficult and challenging times, and I think the top management within the RBI and the banks would have to take a more proactive role in pushing for more aggressive decision making on the whole restructuring structure, a framework that the Kamath Committee has put forward. And all this has to be done with a very clear understanding right now that the future is so uncertain that we really don't know what the economy would look like, what demand would look like, and what revenues would look like for a sector or for a firm in the next 6 months, 12 months, 18 months, 24 months. So I think confidence has to be given to people in the field that please take decisions, and we will presume that these are all bona fide decisions. And if there is anything particularly, fictional, then of course a different worldview will prevail. So the whole objective has to be to somehow keep everybody going till normalcy returns. Now, a slightly silver lining for the textile sector as a whole is that in many ways this is an essential item. Of course, many people would disagree because for the last few months in lockdown, we've all been managing without better shirts and so on and so forth. But as normalcy returns, I think demand would pick up. I mean, on the export front, actually, the signals have been encouraging that many people are looking at India as a place where we could meet a larger part of the global demand. So right now, I would say that within the textile sector, there is nothing particularly specific that seems to be warranted to tide over this crisis, except to ensure that bank credit flows, debt restructuring takes place, and if necessary, a second restructuring may be considered, and the moratorium and the IBFC process remains in abeyance till such time as some normalcy returns. But going forward, when normalcy returns, there may still be a bit of a problem in debt servicing because it depends on the kind of growth that individual firms see and the sectors see, and that will determine the ability to repay. So not only in the textile sector, but across the economy, maybe post normalcy, I think this issue of the haircuts that need to be taken by the banking sector would have to be addressed frontally, because in some ways with the moratorium and the restructuring, we are using the American phrase throwing the can down the road, but I think that's the wise thing to do because firms must be saved right now. After recovery, a view can be taken that this firm doesn't have it in it to survive, or management is bad, or whatever, it needs to go. Now, moving beyond COVID is, I think, the larger question which we need to discuss today, because the discussion is good if there is consensus, decisions get taken, then post-COVID we could really see a different dimension or a different paradigm of growth. So if we look at the sector today, we find that in some ways it is stagnant in terms of its position in the global trading system. And when the WTO agreements were reached, the expectation was that our share would rise very dramatically. The sector is also very important because it is very large, its share in the economy is large, and it's very labor intensive, its employment intensive. So what should be the bigger strategic goals for which preparatory work needs to be done now? So ideally, India should be exporting only apparel and garments. It should not be exporting raw cotton or fiber or fabric. Now, that's a structural transformation. Obviously, it cannot happen in one day, but at the back of our minds, we should be recognizing that that is the optimal situation that we want. The second goal should be that we are non-existent in the global markets as far as apparel and garments from synthetic fibers are made. Global trade is dependent on that. Global consumption is dependent on that. In the global system, cotton is a niche area, not the mainstream. So how do we enter with a big bang in the global system? That should be our second major goal. And within that are sub-objectives that if there are certain markets where our presence are very modest, how do we raise that presence, etc. Now, to begin with, I would say that and this is a point I make often enough, but I'm yet to get enough traction. That is that the real exchange rate is terribly important for any sector where the margins are low and where domestic value addition is high. And this is the case with the textile sector. Now, the real exchange rate movement in 1 year of, say, 5% upwards is equivalent to the lowering of import duties by 5%. So, in terms of reducing competitiveness, this is the lowest hanging fruit available to the policymakers. But unfortunately, there's a national consensus as yet that a strong currency means a strong economy, while the exact opposite has been the historical experience of the last few decades. So, every successful East Asian economy, Japan, Korea, China, followed a conscious policy of keeping the currency artificially low, which is why China has $3-4 trillion of reserves, and use that to get competitive advantage in global markets till they got knocked on the head and they had to allow the currency to move upwards. Now, if you look at us you referred to the recovery after the economic crisis. So in that period till 2017, that is 2008 or something to 2017, we had a 19% real exchange rate appreciation, which is a lowering of import duties by 19%, which is why our industrial growth has been very tepid or modest. So I would say that it's a great strength of Indian entrepreneurs and industry that we still had some modest growth. So the 19% lowering of import duties is a huge shock to handle. So that's the lowest hanging fruit. Now, the second major low hanging fruit, and which is again costs the government nothing, is to do what Bangladesh did many, many years ago. That if you were an exporter, you could import any fabric from anywhere in the world duty free. You would process it into garments and send it to the rest of the world. And you maintained a passbook kind of account in which you could be checked, and their system has worked well. So the imported fabric doesn't get into the domestic market. Now you could easily in India begin with taking bigger exporters who have exports of 300 crores or more and give them this free import of fabric without any permissions and without any regulations. And you keep an account and you're always subject to audit and penalties. Because the garment cycle of design, production, and sale is so tight that even days matter. And this is the one reason why we don't exist in the global market, because the global design industry chooses colors, textures, so on and so forth in such a way that you may want to import it one day from Korea, the next day from Taiwan, or maybe from China or wherever. Until that system is put in place, India will not be able to become an exporter of garments and apparel using synthetic fibers. It has not happened in the last many, many years. It won't happen till this change is brought about. All it requires is a simple notification of the Ministry of Commerce. Costs nothing. Then we look at how to do other big things. So one of the problems of the garment export is that it is highly cost sensitive, it is labor intensive, and it has centered in the more successful parts of India, and where cost of land is high and cost of labor therefore is also a bit higher, and therefore it struggles to achieve global competitiveness. Now the exchange rate would help, but there are 2-3 other things which can be done, and again which would cost very little. So one is that we promote special economic zones for the textile industry, and we create textile parks in the domestic tariff area separately. And both these we need to change from the existing pattern which has flowed since the mid-90s, that the government should retreat and only the private sector should be the lead. So the change that is needed is that state government agencies or central government in partnership with state government should promote these parks and undertake the investment so that you get economies of scale. Because the whole SEZ experience has shown that even in other sectors of manufacturing, we have not achieved economies of scale either in the domestic parks created by the private sector or by the SEZs created by the private sector. And globally, private sector has not been into these big township developments. I mean, you can develop a big township and get a private sector to do bits and pieces. But they don't have the resources or the capacity to do developments on the scale that is needed. And that is the one difference between China and us, because they created these special economic zones, which have become huge cities like Wuhan. So if the state were to create this, then startups as well as new entrepreneurs could come in and come in more easily, because ready-made developed land and infrastructure is available. The one modest success we've had is that with that Brandeis SEZ I think Brandeis is the name in Andhra, Simandhra, where the then CM gave them land at nominal rates. And he gave them land at nominal rates with the understanding that jobs would be created. Now, jobs have been created. It's been a success story. I mean, its growth has been slower, and one has to be realistic to recognize that in any area, there is a lead time before growth really takes off. Now, once you do this, then you can offer plug and play in the real sense of the term. So plug and play would mean that here is a garmenting unit. I have the shed and I have the machines in it. You are a graduate of NIFT, come in, try your hand at being an entrepreneur. I would go so far as to say that if the whole thing is well run, you can say that for 6 months you may pay nothing. If you're confident, you're able to get buyers, manage labor, then you start paying nominal rent. As you prosper, you pay more than the actual cost of the property in terms of rent. So you pay for the earlier free thing that you've got. And if you're sufficiently prosperous, buy it. And the industrial park or the SEZ developing agency can build more sheds. Because unless you provide practically free land and shed and machines, no youngster who comes from a family which is not wealthy or from business background can become an entrepreneur in the brick and mortar economy in the real world. So they become entrepreneurs in the IT world, where you don't need land and you don't need capital goods, which cost anything much. So if you do that, this would be real plug and play. And the Brandeis person actually has done it for a Chinese investor who was giving him something very specialized. When I visited him, he told me that I was buying from him. Then I said, why don't you come and make it here? He said, I've never been out to China. He said, okay, I'll build the shed and give it to you. You come and make it. And he came and he tried it out and he was happy because he handled the cultural differences and the labor well. So if we want plug and play to succeed, we need to do this. Then the other thing that we need to do is to, from the SEZs, change the norms that sales to the domestic tariff area would have the duty which is imposed, or the applicable duty which is imposed to our trading partner, and where the tariffs are the lowest. So if the lowest tariffs are with Bangladesh, we should match that for our SEZ. And sales to the domestic tariff area should be considered as sales in foreign exchange or earning foreign exchange, because sales from an SEZ to the DTA involves substitution of imports from other destinations. So if we bring this change, then many of our own investors could be quite happy to go there, because otherwise the risk of investing and selling in global markets and being a net foreign exchange earner in the existing regulatory regimes of the SEZs is not very favorable in terms of the risk perceptions of investors. And this is a change which costs nothing, because after all, whatever will come into the domestic tariff area will face the same duties as if it were coming from Bangladesh or any other country. So it's a question of consensus between the revenue department and the textile and the commerce people, that if you want to create more jobs in India, then this is the change we need to do. Because changing the overall regime of duties and protections and other things in the existing domestic tariff area is something that will not very easily happen. So the synthetic fiber people have been saying, put us at 5% of GST. It hasn't happened. It won't easily happen because the revenue implications are too large. or any of the other things which keep the domestic tariff area going. Very radical interventions which disrupt things are not a good idea. They're very difficult to persuade political leaders to implement, and I think one should not try that. Now, if you also want to support startups properly, then this is an idea which has been around for many years but hasn't been implemented in the real spirit, and which is that the government looks at a space between a pure grant or an interest subsidy and things working on market rates. So I'm talking of equity capital for a startup which would succeed and support startups, because the expectation of return on capital should be more or less around the cost of capital, you say 100 basis points more. Because private equity or venture capital or angel investors are looking for far higher returns because the risks are far higher. That's the nature of the system. So if we want equity to flow into sectors which are generate jobs, where margins are low, where profits will be modest, then we should look at equity capital, which is managed as professionally by professional managers, but the equity is provided by government or government guaranteed flow of money from SIDBI or whoever, but the fund managers are not expected to get the highest returns or the high returns they get in the IT sector. And so, and there should be patient money for 8, 10, 15 years. Because if you use that kind of patient money, then you grow and create market share and the industry grows rapidly. The fact is that if a young entrepreneur, again, beyond friends and family, there is really no source for equity capital in the brick and mortar economy, and minus equity capital, there's a natural limit to what debt he can raise, irrespective of how good he is or how well he does in the first few years. So this equity fund, which if it is created and is managed by professional managers who get the returns they get in the private sector, but the success parameters are made more modest. It should be in terms of growth, jobs created, the survival of the startups, or the SMEs that they back, their growth, profitability, etc., but all at realistic parameters, because the textile sector is such that it is not amenable to those kind of growths and returns that you get in the IT sector. But for India, it is very critical because you create jobs. So that would be my other kind of big idea that I would like to leave. And then we should also, I think, push the Commerce Ministry and the government to have an FTA with Europe. Because the FTA with Europe almost went through. The textile people said, please do it, then we can compete with Bangladesh, otherwise we can't. But somehow the auto industry and others prevailed, and then there were other, what I would call theoretical issues of environmental standards and labor standards, and didn't happen. Now that India has wisely chosen not to go into RCEP, I think it is the time to push through an EU FTA. And on labor standards, it would be good for us, because anyway, every garment exporter is subject to review by his buyers, and his labor standards are good enough. And similarly, on environmental standards, if we become as good as Europe, we will become more competitive in this century, because we'll have the brand equity value which comes for conforming to the best environmental standards. So my plea would be that we should push for the EU FTA. And in the countries where we have FTAs, which is ASEAN and Japan and Korea, we should take a hard look and try and understand why we are not succeeding. My view is that we are not succeeding because we don't have a level playing field in terms of synthetic fabrics. The day we create that level playing field and then we work their retail chains, Uniqlo or whatever, we will have a big bang entry and growth in those markets. So then we need to look at the worker. And I was so delighted when I heard in the FM's stimulus package announcement that we will work to create rental housing for migrant workers. Now, typically, if you want workers in a new textile park or an SEZ, which is bound to be away from the cities because around cities land is too high or too expensive across the country, then you have to create workers' housing if you want economies of scale. You want to operate on a lower scale, you can take a bus and get workers to come in from the neighboring villages. But the bulk of work in this area is actually being done from labor from Bihar and Orissa, which is traveling all across India. So if you create a large enough park and do dormitory accommodation and run it as a rental housing scheme, then you are confident of being able to locate your parks in areas where wages are low and yet get the same levels of cost and productivity that your competitors have. Because the fact of the matter is, you have the same machine in India, the same machine in Vietnam. And if the worker in India comes and is tired and has had difficulty bathing and needs a cup of tea to get going, there's no way he can match the worker in Vietnam who maybe has walked across. And when we had a globally competitive textile industry over 100 years back, all the large textile mills in Mumbai, Ahmedabad, Kanpur, Calcutta had workers housing right on the premises. Now, today, no investor will do workers housing on his own. So the park developer has to separately promote workers housing, maybe in PPP, etc. Do it maybe outside the park so that there is a better, management of industrial relations, some distance away, etc. But without workers housing, India cannot be competitive in anything that is labor intensive on a large scale. So that is a major thing which needs to be done. Now, in all this, there is the issue of funding. How do I fund all this? Now, if you're looking at financing for a very short period, it is very difficult. But if you're looking at long-term funding, then it becomes very successful. And the model that comes to my mind, of course, we may need to redo it in terms of the current systems. But if you look at DDA, or you look at Noida, or you look at Greater Noida, they all got a very modest sum of money from capital called the revolving fund. Basically, it's equity where they're not looking at any returns. So this money was given on no profit, no loss. They were asked to develop land, sell, run on no profit, no loss basis, and create infrastructure and so on. And these are great success stories. I mean, Delhi is, I think DDA is sitting on cash of many thousand crores. The people who've taken land at no profit, no loss are all very wealthy. And how quickly it can move, again, I'll give from my experience of Greater Noida for a very short while. So when we began, we had acquired land and I'd practically run out of money. I had to borrow from Noida. A friend of mine, he gave me some money. I returned in a couple of months, a cash flow problem. But when I left in that period, we were sitting on cash of 100 crores. So if you ask a private investor to go and do this on a large scale, nobody will do it. So this is the other big thing, that you finance that. And then I would come to the existing industry in India and what do we do with it and how do we make it better. So we have a whole powerloom sector where the need is to modernize and modernize aggressively. Now, if you had, again, in PP board or again a government agency moved in to do what government agencies don't do in India and take the risk, or government guarantees a private partner. So essentially, you replace the obsolete power looms with state-of-art power looms on a hire purchase mode. So if you do it on hire purchase, the investor has no risk. He's not taking a government or a bank loan. He doesn't need equity. He pays from the gap between his productivity and revenue from the old machine and the higher level of productivity and efficiency. I mean, in fact, there's an energy efficiency study which says that the payback comes only from the savings in the electricity bill. And if you see Bhiwandi, etc., every few years there's a big hue and cry that, give them a subsidy write-off bills, or government should order the electricity system to give them subsidized electricity. I mean, any industry which has to be sustainable needs to look at a business model where you are not looking at subsidies from government or any government agency on a long-term basis. For a short period, tiding over, yes, but to run a whole power loom industry where electricity has to be subsidized in perpetuity makes no sense. So the way to do is to get them to modernize. In parallel, you need to identify all the clusters that are existing and get an audit done by the National Productivity Council, the Quality Council, to establish where they are in terms of competitiveness. and then work out a turnaround plan where 3 to 4, 5 years you aim at a higher level of quality and productiveness. And if it is properly designed, it should have payback. So it shouldn't need subsidies beyond funding the technical consultancy or the audit pre-turnaround strategy and post-turnaround, date. Because we have to bring up the quality of these people. Otherwise, with the liberalization and opening up of the domestic market, they will face increasingly difficulty in terms of surviving. You see, in the metros itself, all the malls have come up. They moved to tier two, three cities. All these branded stores are there. And what is there in the branded store is what is being sold or purchased by all those who can afford it. And the young also drive consumption in a certain direction. So we have challenge of ensuring that our existing industry survives well enough. And my final point would be that if we do start succeeding in the export market, then I think the government should come in with some credit guarantee scheme which allows an enterprise to grow at 50, 80, 90% or 100% per annum, because the normal flow of credit and equity will not enable this kind of growth. So in their great days of growth in Korea, the debt equity ratio was as high as 7:1. And China, of course, it's a black box, nobody knows. But in each of these cases, the banking system of the governments could take the risk because the firm was succeeding in global markets. So they were very sure that they are competitive in terms of price and quality, they are gaining in market share. So if you back them fully, in odd case, things will go wrong, but the money is safe. And the problem with India is that we say, I'm not sure, I'm a little out of touch, but I'm not sure that there is any firm which can take on the full season order to given to one major supplier, but by any textile or clothing retail chain in the US. I mean, the capacity to handle those volumes would probably not be there. And until that capacity is created, the big markets and the big chains more or less get closed for the Indian garment producer, except in his niche area of cotton, etc., where of course the sales are always thin. So with these remarks, I think I would like to say that we would need, I put it more strongly, we need greater ambition. And then we need the drive to bring about the regulatory and policy changes, restructure our government programs, and look for a big bang growth where we actually start taking China's market share in global markets. Because when the WTO came, the expectation was that our share in global markets would rise and catch up with China's. It hasn't happened. But now there is another opportunity. If we do the right things, we can make it. Thank you.
So much, Mr. Sankar. I think I cannot summarize it in 2 3 points. It's complete a policy, complete textile policy maybe fit into this. So it's a very interesting insight covering government, covering funding agencies, covering what private players need to do. Whole lot of things. It's very interesting. I guess it will be a very wonderful. Audience will enjoy the whole conversation. Now, I would like to introduce Mr. Sanjeev Agrawal and Arindam, who's from PwC India. Sanjeev is a partner with PwC India Corporate Finance and Investment Banking practice, and he leads the debt advisory practice. He has around 31 years of extensive experience in restructuring, project appraisal, debt syndication, and advisory across the sectors. So Sanjeev has worked with cross-section of industry, both private and public sectors, banks, financial institutions, including multinationals, government departments, and lead mandates successfully across the various segments. And Arindam is the Associate Director with PwC India, and he leads the textile practice. He's a gold medalist from IIT Delhi, and he has worked with this industry for more than 22 years now. And he has experience of working in Indian subcontinent and Southeast Asia with the private sector clients, government, international developmental agencies. And now I just hand it over to Sanjeev and Arindam. Over to you.
Thank you. Thank you, Debola, for your comments. Probably I will take first few questions and then Sanjeev will join. Let me set a bit of context also. So we are doing it as a series, and there are 4 episodes which we have planned. The first one was on the potential change in the trade flow in the new normal. The second and third one was on two important topics, sustainability and technology, which we believe will probably make the major difference between the winners and the losers. But to do all these things, we need finance. And so today's topic that how to repair our industry, then revive, and then look for the growth. So in the panel discussion, I will first come to Mr. VK Singh. Mr. Singh is currently serving as Additional Secretary and Financial Advisor in the Ministry of Textiles, Government of India. Beside the regular works, the most important point which I would like to highlight that he's spearheading now the development of a new textile policy of India. So who can be a better person than him, so that we can put forward our thoughts, requests from the industry sides that what we expect or what role probably we will be expecting from Ministry of Textiles, and then it's up to him that how he can accommodate those. So, sir, I will not come to textile policy per se because it's still under drafting stage. Let me ask you a nice question. I mean, there is always a dilemma that whether it is subsidy which will work or is it incentive. So, what is the plan of Ministry of Textiles? Will it still remain a subsidy-driven system, or we will see more and more incentive-driven system?
In fact, now you are yourself answering the question. This government believes in minimum government and maximum governance. So definitely, if we have to move away from subsidy regime, because subsidy has many ill effects. It disincentivizes the proper working and all, and that it develops its ecosystem, which is injurious to the long-term development of the industry. So basically, that's the government stand anyway. But definitely, like when Sir spoke about the issues pertaining to textile sector, it's so vast, and our clusters are so at a different level that some of them may need support, and support is basically subsidy. If you are subsidizing certain activity, some study, something, they have to make more competitive. So basically it cannot be, subsidy cannot be stopped in a day, but definitely government will always want that subsidy should yield place to incentivization. So once, like we have all sorts of weaving system, handloom, power loom, rapier, shuttle lace, so many things and all. So how can we bring them together unless until we at least bring the lowest one little higher or at least some level. So some subsidy to the lower section of industry will have to continue. But definitely we have to move towards more and more towards incentivization. That is my understanding.
Thank you, sir. So what I understand that probably we will be able to see a better balance between the subsidy and incentive in the coming time, hopefully.
That is the only thing.
Yes, sir. So let me put this next question to Mr. Upendra Kumar Gupta. Mr. Upendra Kumar Gupta is presently serving as the Deputy Advisor, Industry, Niti Aayog. And in his present role, he has been closely involved with all the textile and apparel sector advisory and supported the industry with his policy advice. So, Mr. Gupta, if I can come to you with the next question. We know that India has potential to be a global leader in both the traditional textiles, that means apparel, home textile, and also in technical textile manufacturing. I was very much interested to see that you have also come out recently with a paper on technical textiles. So I would like to understand from you, what is the plan of Niti Aayog to place India as a global leader in both traditional and technical textile manufacturing?
In my opinion, in today's scenario, promotion of apparel and technical textile manufacturing in India are closely linked with promotion of man-made fiber sector in India. Without focusing on MMF sector, we cannot go alone for promoting technical textiles in India. Our policy schemes are skewed towards promoting cotton fiber in India. This is a natural fiber. If we talk about some data, India imported around $1.2 billion worth of MMF fabric in 2017-19 from the countries like Taiwan, Korea, and China. However, with the increasing cost of manufacturing in these countries, there is an opportunity for India to attract investment in manufacturing these MMF product categories in India. Realizing the potential of MMF sector in India, GY has already abolished anti-dumping duty on polished PTA, which will result into reduction in price of polyester fiber available in India. Abolition of anti-dumping duty will be a boost for PTA users, and it will reduce the price and will make more competitive in the global market. I hope that we are also actively pursuing the GST issues with the Department of Revenue, and I hope that this will be resolved. Inverted duty sector will be resolved very soon. These initiatives will bring down raw material cost to a very competitive rate, and this will make our MMF sector globally competitive. Further, in order to particularly promote textile technology, the government has set up a national textile technology mission with an outlay of 1,480 crore, with a view to position the country as a global leader in technical textiles. I think this initiative is a very great initiative for promotion of technical textiles in India as well. Thank you.
Thank you, sir. Thank you for your insights. May I now request to Sanjeev to take over?
Thank you, Arindam, and thanks for this session. We have today Mr. Ajay Shankar, Textile Ministry, Niti Aayog, lender. It's a complete people who are required. So before I get into questions, a few thoughts. One, like Mr. Shankar mentioned about 3-4 big things, stagnancy in export. That's something I would say an understatement. What we see statistics wise, while China continues to be surpassing everybody, and Bangladesh and Vietnam have crossed us in terms of global trade, which is where we need to do some catching up. Mr. Shankar again brought out a point, man-made fiber, as Niti Aayog has also said, is a big piece where we are kind of not that big a player. So we need to focus on that. And third is the economy of scale, on which I will also deliberate with Mr. Sivakumar. But let me break it into two pieces. One is repair and revive, and second is growth. When we come to repair and revive, is a situation COVID and in general, what is happening to textile sector. In repair and revive, we have, again we break it, MSME as a sector has been given, I would say, a very good package by government, and that package entails additional funding backed by government guarantees with a tenure of 5 year, equity, subordinates, so all mixed. The only thing would be probably as textile ministry, they would need to see that this major chunk of this comes to their sector, and they need to proactively work with the industry and MSME pioneers to get that towards the textile and fabric sector. But now we look at the contrast. While MSME has been given funds to overcome the stress and come out of the stress situations, the corporates above that have been given a one-time resolution package, which is nothing but a restructuring. So on smaller, we are giving a good package, equity, fresh funding to overcome the debt. For larger one, we are giving a package, which is a resolution, which means you will always be in strain. And why I say you will always be in strain? The package says that banks will need to make a 10% provision when they give this package. So it's a penalty on the banks, and it's a penalty on the corporate, who would be kind of classified as a bucket where there is a provision. And this provision will continue, unfortunately, which I have been repeatedly pointing out in various forums, till 30% of this outstanding debt is reduced, it is very unfortunate. A restructuring package given by RBI last year said the provisions would be reversed when 10% of the debt is reduced. In NPA cases, you are allowing the provision can be reduced when 10% of the loan is reduced or repaid. In a one-time COVID-related stress package, we are saying this will continue till 30% of the debt is repaid. Very unjustified. So my request would be various policy makers should really go to Ministry of Finance and RBI and get this rectified. I am seeing repeatedly the banks are averse to give this one-time restructuring package, and if it is not quickly overcome, probably I would ask Mr. Shiv Kumar also to speak a little on this. It will not. This package will not really work, and even if it works, it's a restructuring kind of a tag, which is for the large corporate entities are getting. Second part is growth. Now, growth on a repair and revive where restructuring has happened is a challenge. So, very good corporates in sector would be able to take up. But in this entire play, growth again is one startup growth, whether we have certain incentive mechanism for textile and apparel sector is one area which we have to see, and growth of large scale corporates, whether we are ready to take that opportunity, which is again a one time opportunity because of a space in global market because of China which is getting created, whether we are doing educate stuffs as government and as textile sector fraternity to ensure that we get our rightful place and accelerate our growth is that area which we need to focus. So two buckets, repair and revive. In MSME, I would feel good things have been done. Only we need to see that it gets implemented. Governance, what Mr. Singh also mentioned. In large corporate, things are not right. There is going to be a challenge, and that needs to be addressed. Coming to from here, if I move on the financing part of it, so before coming to it, let me introduce Mr. Shivakumar. Mr. Shivakumar is General Manager from Exim Bank, and Exim Bank as a pioneer for the entire export sector for the government of India and for the country. He has more than 2 decades of experience, has headed the Exim Bank from its Washington office, has been heading Chennai and Bangalore. So he has adequate experience and focuses on this sector also. So welcome, Mr. Shiv Kumar. So my question to Mr. Shiv Kumar would be, like I mentioned, while MSME has got a relatively good package, is that enough, or economies of scale would play a big play if we need to go forward? And what could be the incentives, the system, or as a country which we can bring in to address this? Because economy scale is going to be a likely big challenge. Mr. Shiv Kumar.
Yeah, thank you, Sanjeev. I'm happy to be part of this event organized by PwC and Textile Excellence. If you ask me whether MSME or scale economy, in fact, I think country has to go towards scale economy. Before directly answering this question, I want to put the things in perspective. If you look at India exports about $35 billion last year in the calendar year. And until 2015, India was the second largest exporter next to China. Then in 2016, Bangladesh took over. We became third position. And currently, we are in the sixth position. Even Vietnam has taken over. So if you look at one of the reasons for India not achieving its potential is a fragmented and smaller size of operations in India, which deters Indian manufacturers to capitalize on economies of scale. As everyone will be aware, MSMEs with a little less automation account significant share of textiles, and even clusters. We don't have many clusters. We have clusters like Tirupur, which are very well known in the worldwide in terms of knitwear. But these clusters are often even one-fifth of the size of competing nations. Countries like China, Bangladesh, Vietnam enjoy comparative advantage given the scale of operations they operate in. So in the current context where the size of individual enterprises is relatively small, the options what we have is consolidation, automation, and or increase efficiency. Increasing efficiency has its own challenge in terms of capital investment and the moving up the size. So I would prefer in terms of scale economy compared to focusing on MSMEs needs to be there in a maybe in the certain segments of value chain, but in the larger scheme of things, I think we should focus on scale economy.
Thanks, Mr. Sivakumar. So my next question would be to Mr. Upendra from Niti Aayog. He mentioned about certain programs for the textile sector. One of the kind of concern has been that not much has been done on the startup ecosystem. Now, when we say startup, normally everybody gets into IT and technology space and nobody talks about technology. Whereas as a startup, countries like Bangladesh, Vietnam have focused on this sector, both textile, fabric, technical textile. There are various sub-segments where, yes, it may not have that fantastic returns where IT or a completely new solution comes. But is it doing something to ensure that there is a allocation for startup which relates to only textile sector, and it can, in collaboration with textile ministry or something, come out with a package which incentivizes people to come into this sector and create their niche areas, market segments, which then can be scaled up for the global growth? Mr. Upendra?
As of now, there is no dedicated fund allocated for promoting startups in textile per se. However, our parent ministry, DPIT, Department for Promotion of Industry and Internal Trade, he is running a program for startup ecosystem in India, where the 19 sectors have been identified, various sectors identified, and including textiles as well, for promotion of startup ecosystem in India. Startup ecosystem India was initially launched in 2015. The Flexing Initiative has an objective of to build a strong ecosystem for nurturing innovation and startup in the country. In starting 5 years, it is now it is at a mature state. Now the which is mobilized on this issue. Now the ministries are very active and they are responding very promptly on this issue. Definitely, in the coming future, we are planning to make some dedicated sector-wise, ministry-wise allocations for promoting startups in India. Thank you.
Thanks, Mr. Upendra. I think, yeah, so like I said, focus, if we can create a sub-focus, because like I said, startup ecosystem has been doing well on sectors which are IT, technology, maybe pharmacy, but textile has not got a right piece in it. So probably in collaboration with Ministry of Textile, we could do something better or more here. Moving back to Mr. Sivakumar, like I mentioned, the new RBI guidelines for COVID-related stressed companies, vis-a-vis the old circular of restructuring via NPA route, is one point which I raised. And second is, Kamath committee has come with the financial parameters. I'm sure Textile Ministry would have also noticed the ratios given include one ratio called total outside liability by adjusted tangible net worth. It should not exceed 3.5. Now, what it means is total term debt, total bank borrowing, total current liabilities, any outside liability should not exceed 3.5 times of equity. I have done several project funding, then raising funds. Typically, term loans, debt to equity is 3:1 because there is a tough subsidy, so it can take these kind of funding, and bank have been happily financing projects from corporates at 3:1. Once it comes into operation, it definitely requires substantial working capital. Their working capital cycle is higher. So, in given this scenario, do you think people will get this benefit, if at all, on-time restructuring bank support?
Thanks, Mr. Sanjeev. In fact, as you rightly said, we should compare with the June 7th circular, which was available earlier. And here again, I would like to divide into the RBI COVID package for moratorium 1, which was from March 1st to May 31st. And moratorium 2, which started from June 1st to August 31st, and the restructuring package, as you said, Mr. Kamath's committee. In fact, from the bank's experience, we have seen two categories of borrowers. The first borrower, we were just waiting for their announcement, and then they said, "Yeah, we will go for moratorium one." And you won't believe they were request after we approved, they came back and said, "No, no, we don't want moratorium because our rating agencies say that they will list and maybe in the future it will affect. So please cancel the moratorium. We will pay on time." This is one category. The second category of clients thought that, okay, this is a short period of moratorium, so we can manage for 3 months. But when it got extended, they said, no, no, I think we need to take. So I think there were two broad categories of clients. In fact, the general sense is that I think the borrowers were not able to judge how long this code would be and how much support they would require. And touching upon the Mr. Kamat's committee, before that, in Exim Bank, compared to the share of textile accounts in the overall assets portfolio, the request from textile accounts for moratorium is significantly higher. So while in the face of it, we'll think that, okay, textile, as Mr. Shankar said, in the face of it, we feel that definitely demand is there, at least in domestic market. So it will get revived. So we also felt, we thought that pharma will benefit, textile will not greatly impacted. But to the contrary, textile was one of the significant affected sectors, at least in Exim. And a lot of people came for moratorium. Compared to the restructuring, in fact, only 10% of companies who availed moratorium in textile have said we want restructuring. Less than 10% said we want restructuring. The balance about, because actually as a pre-active step, we have started discussing with the companies who would want. So less than 10% said we would require restructuring. About 56% said we may or may not. The balance about 34% said we would want. We wouldn't want. But what we feel is that I think people again have not seen this in detail, and some of them not make their mind because there is a time till December 31st to make a decision. And as you rightly said, these 5 ratios, in addition to what ratio you said, TOL by adjusted P&W, another ratio where we feel there will be a challenge is the current ratio. Especially companies in textile which are export oriented, their current ratio is slightly relatively less compared to 1.33 because the margin expected is 10% for exports. It hovers between 1 to 1.1, and currently because of this COVID, it has actually fallen below 1. So apart from the ratio, what you said, even I think the current ratio will have a challenge, and we are not sure how many companies would be even eligible under this, the package. And I think the companies are waiting and watching whether we should restructure on, because they feel that there are another 2-3 months which is available to take a decision. And we expect that I think there will be a lot of requests for restructuring because I don't think it's even going to end in December. It's going to extend. So I think maybe government should think a little more a deeper restructuring or a little more lenient norms or for an elongated period. And as rightly said about the provisioning, the only benefit is that maybe the GNP ratio and NNP ratio may be slightly GNP ratio will be NP ratios will be better, but we need to make provisioning. So overall, I think they maybe need to maybe RBI might rethink and maybe consider if the COVID is extended. Thank you.
Thank you, Mr. Shivakumar. So that's really useful, especially your experience in terms of what has happened, because I think it's a little early times, like you said, of the corporates to consider whether they want to go for restructuring or they will hold on. But what we see, because these are early time and preparatory time, as advisors, we are getting huge number of inquiries. And in this sector especially, there is quite a difficult situation, and large number, if they don't get this package or they are not taken under this package, they may have to go for a pure play restructuring. Demand is still to take off and the situation is not so great.
One more thing which we have seen, companies which have availed facilities under TUFS, they don't come for moratorium because I think they become ineligible for the interest subsidy.
Yeah.
So there are companies which has loans under TUFS, loans under normal lending. So they've taken moratorium for normal lending, but for TUFS they said no, please don't do it. We will pay on the schedule. So the recommend for moratorium is really not based on cash flows also. It is based on what is available. So that just want to touch upon, because the TUFS angle also plays a role. Maybe like if no, government may also think, because in extraordinary situation even TUFS loans can be considered. Maybe then I think no, people will actually come out and say that yes, it's better we take. So that's another point since talked about TUFS. Yeah.
In fact, thanks, Mr. Shivkumar. I would address this to Mr. Vijay, Mr. Singh, just to explain what Mr. Shivkumar is saying. What happens is, you don't give additional benefit by way of TUFS. Suppose it is a 10-year loan and you give a 5% interest subsidy based on the reducing balance of the loan. After 5 years, the loan now needs to be restructured to residual 5 years has to be increased to 8 years. You pay your only interest subsidy to the extent what you had committed. Amount wise, it doesn't impact. But the scheme is structured in such a way that if you elongate the repayment period from 5 years to 8 years, then government will withdraw that interest subsidy benefit. So a lot of industry people are avoiding that, but it is putting undue pressure. And the non-TUF lenders are saying, when you are not taking in government's scheme, then why should I give you any kind of a benefit? So my sincere request would be, maybe we could give you a small paper on that also. If it could be looked, it would be really helpful without increasing the subsidy burden for the government year on year, which anyway has been provided by the government.
I don't see any problem in that, but I have not seen any requests as such. We have done many changes in last 6 months. I don't know how many times we have relaxed, we have changed rules and all to make them somehow workable. But this type of request I have never seen it before.
Yes, sir. So it is actually in the policy under the tough scheme when you avail this, like Exim Bank mentioned. So it should actually come from the textile body, maybe Mr. Guhan or any of the textile body should come forward and explain why it is, and it should not put additional government burden to government. That I am quite clear. But without putting additional government burden on the government, this can help in only elongating the repayment period. So
yeah, we will find it not very difficult to handle it if some request.
Sure.
It's good that it is discussed now, so that no, like this will be really helpful for textile companies. Yeah.
So that would be a real, Mr. Gohan. I think you should definitely take it forward with the industry, and we can help you on that so that it benefits the entire sector along. And banks. Banks also will be then more than happy to support it.
Yes, Sanjeevji, I think this is a very doable and practical kind of approach where everybody is becoming a winner. Banks are comfortable, ministry is comfortable, and industry, of course, I mean, they are always with a begging bowl at this moment. So this could really help, I guess. We'll definitely take this discussion to the industry, and we'll coordinate with Singh Sahab and Mr. Kumar, and of course, Sanjeevji, you are there. So if it is a win-win situation, why not? And this is the whole purpose of this discussion. So now coming back to the discussion for taking this discussion forward, I have one question from Mr. Gupta, Mr. Upendra Gupta. We understand from earlier episodes that we have discussed with various industry experts and of course various sector specific experts. We understood that the adoption of sustainable manufacturing, penetration of digital technology, and process automation will play a major role in deciding the future winners of the industry. We understand that India is lagging all these three areas significantly compared to all our competitors. We are lagging significantly. So what is the plan of Niti Aayog to bring in a transformational change for this industry?
Definitely, sir. These will play a major role in deciding future winner of textile industry. I mean the sustainable practice. I mean the textile industry, including using less amount of water, hazardous chemicals, adopting eco-friendly production process, using less energy for production process. These are the means for sustainable practices in the industry, and introducing 3 R's like reduce, reuse, and recycle. Whatever the sustainable manufacturing and sustainable practices are concerned. adoption of latest technology. We bring all these three things, whatever you are asking: sustainable manufacturing, automation, digital technology. We bring all these things in a one bucket called adoption of latest technology. And in this, in your question, definitely the adoption of latest technology is most essential factor for the development of our industry. These are my rough estimate that 80% of garment production units in India are operating in small scale sector. Due to this, textile sector in India, except few big players, have very low technology and low automation levels. Technology upgradation is a big challenge for these small scale units with limited resources, as they are also having capital crunch problems. Recognizing the need of technology upgradation in textile sector, the Ministry of Textile has introduced amended technology upgradation fund scheme in 2016 with an outlay of 17,800 crore for a period of 7 years. With a view, the objective of the TUFS is to provide state-of-the-art technology to our Indian textile industry. The scheme provides one-time capital subsidy for garmenting at the rate of cap of 30 crore, whereas for weaving and process sector, it is a cap of 20 crore. These are our estimates in consultation with Mr. Textile that this scheme will attract an investment of 95,000 crore for technology upgradation in textile sector. Apart from these our central Ministry of Textile or central government schemes, state governments have also been launched several schemes for promoting their textile industries and as well as ensuring technology upgradation of their textile units.
Now I come back to Mr. Singh. I mean, you have a lot of things to answer. I guess a lot of things, thoughts are going inside your mind. But along with your thoughts, I would also like to ask a question. We have seen that there are many critics, and they say the problem is not in sufficiency of funding, rather than the effective utilization of the funding to the textile industry. Is there any plan? I mean, you are running a lot of schemes. So is there any plan to make these beneficiaries more accountable? Should we look at ROI of the investment made through different schemes at different parts of India for prioritizing purpose?
You might have seen these implementation of TUF and all has been streamlined in recent past because it was felt that things are not very accountable because people were importing second-hand machines. It was happening in the brown field industry, so you don't even know that whether something new has come or not. So we have learned from our experience, and we still feel that the evaluation of that TUF is happening. And after this evaluation report, we will have some more changing to make it more focused, in fact make the benchmark higher. If technology upgradation has to happen in a real sense and in a focused component of industry like weaving, processing, which has not received fund, some more incentive will be there in those areas. So those type of changes are likely to happen, but we are waiting for the evaluation, the third-party evaluation report. The moment it's there, we will take it up.
Continuing with that question, continuing with this, I have one question to Mr. Sivkumar. We don't see much of startup funding. Again, this startup is again coming up when this is something we want in textile sector as well. So we don't see much of startup funding in this sector where many ideas are very promising. I mean, there are some technical textile items which can really give returns like IT company. So what role can lending agencies play here?
It's a very interesting question. From a lender's perspective, we would be always comfortable in a traditional sector, brick and mortar, where there is a security, where we see the raw material going inside, output coming. So we have a sense of what's happening, and we have a sense of monitoring the progress. So that way, from a lender's perspective, I think that's an excellent sector. Like, that gives a comfort for lending. But whereas if you look at in terms of equity funding, the challenge would be the people who like to put in money either as an angel investor or as a VC or a venture debt. They look at more in terms of knowledge and service economy, where they look at because they are investing and they're taking huge risk. right? They're looking at an upside in terms of valuation. And there, one of the parameter is that it's a new idea. Look at, I'm just giving an example. Let it be, Ola, Uber, or like. So these are Swiggy or Zomato. They'll be bleeding. Okay, they'll be bleeding, but they capture significant. It's a new idea. It's a new concept. They achieve significant market share, and then when the investors want to take back their returns, they get through a significant valuation. So that's one of the, I think, challenge in terms of the textile, or for that matter any traditional sector, in terms of attracting equity investments to this sector as a startup. So that's a challenge. But as you said, if there is a excellent idea, then maybe yes.
Thank you so much. We are almost done with the formal our questions. Now we have few questions from the industry. I would request Arindam to take it over.
Yeah, thank you, Deepada. Thank you very much. So yes, we have some very interesting questions. I will say that from industry. So let me put the first question to Mr. Singh. Sir, the question which we have received, that COVID-19 pandemic has impacted the textile and apparel industry significantly. Government of India has announced several measures which are applicable for all industry. What special initiative have been taken by Ministry of Textiles for saving this industry? So that's the question we have received from one of the industry partners.
Yeah, definitely in the short span of time, what is required is the restructuring of the loan, some more credit support and all, and for that those things will be done by the Ministry of Finance and RBI only. Nobody else can do anything. But Ministry of Textile takes it as a very, very important, basically watershed moment type of thing. We have got some time to focus at our activities, and we have assessed our all schemes internally and the entire delivery system. So we are taking it as an opportunity that let us re-engineer ourselves, and from a geo-based budgeting thing. Whatever we have been doing, even if some sunk cost is there, but if it is not giving return, definitely those things will have to be left now onward. So the moment I heard today only, I have been hearing for last 1 week and all, that the steel market is picking up, a lot of demand has come in. Even somebody was talking, the Maruti has the world monthly record monthly production in last month, and huge demand. They are not able to meet the demand. So I hope the moment things improve, even textile will get into that move, because even cycle like that, once the pent up demand will definitely come. So, but then are we able to capitalize on that demand whenever it comes? So we are working on the textile policy, which is going to be more focused and more basically effective intervention, not a huge drag on the government only, but basically we will like to leverage on the entrepreneurial ability of the Indian people, basically. That's the thing. One question which I heard earlier, I will like to respond. Definitely we are going to seriously think on that startup ecosystem in textile. We have a huge network of NIP, and they have contributed heavily in the small startups and all, and they are doing quite well. So we will not be able to do some organizing now, but certain small things are happening. All the NIPs are now setting up their incubators. So their alumni can set up their unit and all. And then when they come to some size, some level for their growth, the ministry, we will get in touch with BPIIT, which basically handles this startup thing. So jointly with them, we will do definitely something for textile sector startup. There's a huge potential for that.
Thank you for your encouraging words, and we look forward to see a vibrant startup ecosystem in textile industry soon. My next question is to Mr. Ajay Shankar. And sir, one question has come from the industry for you. The question is that we have not seen much of private equity investment or foreign direct investment in this sector yet. How can it be improved? And whose fault is it?
So I said in my opening remarks, and I repeat, the textile sector is not one for such investors because you will not get those high rates of growth and return. This is a sector with low margin, but very important for us because of the employment generation and therefore the impact on reduction of poverty. So I had said in my earlier remarks, and I'll repeat, that there is a strong case for creating a dedicated equity fund, SBI, LIC, or wherever, where the expectation of returns are low and units are financed, which are through equity, so that they can grow and grow very fast. Because in the absence of that, their ability to borrow is limited. So if I am an exporter and I'm glad to hear these success stories, then funds should not be a constraint for the growth of these startups. And that can only happen if there is a dedicated equity fund, which then allows them to go to banks. And even with banks, I would urge that a higher debt equity ratio should be made permissible by change in regulatory requirements as long as the unit is exporting and exporting successfully for a few years. Because in great growth days, in the IT sector, they grew at 24, 25, 40, 50% in India. They didn't need financing because it's a service. But if you want 40, 50% growth from a garment exporter, you have to take care of his equity and debt needs in ways which are very different from what is applied to the domestic economy. Now, coming to FDI as a whole, you see, whether it is domestic investment or international investment or FDI, we need to recognize that it looks at returns and profits. There is nothing else that drives those decisions. There may be very friendly countries and we may have very, very good, formal events. But an actual investment decision only flows from assessment of returns and risk perception. Now here somehow we have not had success in getting FDI either in textile equipment manufacturing or in the bigger plants which do create man-made fiber and so on and so forth. And I believe that we could overcome these difficulties if we had a large enough textile park, both in the DTA as well as through an SEZ, promoted by the state where land and clearances are provided very quickly. You could even have advanced environmental clearance for a processing unit so that the investor can come and be confident that he can put up his plant in 18, 24 months and then can expect return. And that return, one component which I believe would make quite a difference is that if he's free to sell in the domestic tariff area, paying the duties which are applicable to our trading partner where the import duties are the lowest. So with that framework, we should be able to get investment. Of course, actual investment promotion will also be required and handholding. But the business case will emerge like this. Because I don't think India can afford to subsidize FDI to get large FDI. I mean, we can't even afford to subsidize domestic people beyond a point. And in fact, I think the thinking of government is right. That let us see how we can move away from a perpetual subsidy regime to a regime where we create the business case for investment and rapid growth. So that is the right way to move forward. In fact, I've heard an expert once argue that the moment you start a program in the country on a subsidy, you are constraining its growth potential because the growth will be limited to the budgetary provision for the subsidy. And the budgetary provision for subsidy can never be enhanced to match the full growth potential of that sector.
Mr. Arjun, to just add on what Mr. Shankar said, a couple of things. He was mentioning about could the financial system plan for special equity fund to support such companies. In fact, in this budget, the Honorable Finance Minister had announced Exim Bank, along with the support or knowledge, along with the partnership of SIDBI, has introduced a new program called Ubrate Sitare, which is exclusively for companies which are small now, but which has huge export potential. Such companies, we offer a combination of debt, equity, as well as grant. So this is a program which has been just launched, and because of COVID, I think it has not picked up. But I think we are putting a lot of focus and effort on this program to be taken to all sectors, and definitely textile could also there are good companies that can benefit. To add one more thing, what Mr. Shankar said in terms of the JVs and what you asked. In fact, we as Exim Bank itself has funded a few of wholly owned subsidiaries and JVs, which are like they are case specific. In a normal case, it is not required, but there are large business houses in Europe or US. They want to set a manufacturing base, so we have funded such companies as well. So the JVs happen and we have funded. But what Mr. Shankar said, it will not be required for all companies. It is more need based.
So we have one more question, and that ends our question answer session. So Sanjeev, would you please take it?
Yeah. So this question is for Mr. Sivakumar, and it reads: Exim Bank offers line of credit for various countries and industries. The textile and apparel industry has not used this facility much. What are the reasons? And would Exim Bank be able to promote it in textile and apparel industry?
Yeah. Sanjeev, thanks for asking this. See, these Exim Bank lines of credit, you would be aware that it is extended at the behest of Government of India. And while Exim Bank extends line, it is the prerogative of the borrower, the country there, to decide which project they want. So the country will decide what is of strategic importance for that country. But having said that, I wouldn't say that textile is not possible, but basically we should promote Indian textile missionaries per se as more as a brand, so that these countries, especially in Africa, where they can see value for money, they can say, yes, I see value. See, like for example, there are sugar projects being put up, which is being covered under lines of credit. So if there is a demand created, and if the country decides based on strategic importance that yes, we want to put up a textile project and import textile machines from India, it can be covered. It's more a prerogative of the borrowing country. But having said that, we also have a program called Buyer Credit, where it can be given to an overseas borrower, and sometimes we give a credit line to an overseas bank. In fact, as we speak, we have been discussing to a country in Central Asia, where they are looking at a special line from Exim Bank to cover some of the projects from India, of which one is a textile missionary. So while line of credit is more a G2G, but something like the buyer credit or a credit line to a bank can work more in terms of a commercial terms. So while Exim Bank can continue to support in terms of textile machine in terms of commercial, but line of credit is more, as I said, the decision of the borrowing country.
Thank you. Thanks. That's useful. And I think if it gets properly promoted, it can really help a lot of textile sector industries. Because ultimately, G2G, if somebody comes with a proposal, it is always taken on a positive. And like you mentioned, Africa, if you would have seen, there has been a lot of trend of purchasing cotton from, or having a cotton fields, agriculture in Africa, and getting the cotton in India. Maybe it can be promoted that you could set up a few facilities in that country to use it there itself. Thank you.
Yes.
Thanks a lot, Mr. Sivkumar.
Yeah, welcome.
Over to Mr. Gohan for the final words for closure.
Thank you, Sanjeevji. Just as a last query to Mr. Singh, if you have anything to respond to the whole discussion, I would request you to take it up. Then I'll conclude with the thank you note.
It has been very, very educating for me also, because I'm working on that policy document. So I think I have learned quite a lot, and I hope it will improve my work on that. That's all. I just wanted to thank you for that. But this is an opportunity. it's a very, we also understand the situation in the textile industry there. It is such a old industry in the country and such a wide variety that it's no one description can describe it. So we have to basically somehow improve, and we can't. There are traditional families. They are not into textile now. They are doing something else. There are new people coming. So all sorts of things happening at the same time. So how the textile industry of future will come? So this is basically a very important introspection which is happening in the ministry and all, and you will see the output very soon happening. Thank you.
Thank you. Thank you so much. I personally thank each member of this esteemed panel for discussing every aspect of financing which will help the textile and apparel industry repair the dents, revive, and continue its growth. Textile Excellence and PwC India would like to have you all again for knowledge sharing sessions like this. I'd like to add value to all of your efforts towards better financing solutions to the textile and apparel industry. Thank you so much.